Afternoon, everybody. Thanks for joining us today. My name is Kelly. I am from CAFL. I'm proud to present our first one of the learning series with John Hancock. So we have John and Mark with us today. And John, I will let you introduce Mark and take it away.
Oh, thank you, Kelly. Appreciate that. Thank you for having us today. It's an honor to be with our friends at CAFL. We enjoy a phenomenal partnership with your firm and all your folks. You're great business partners, but you're also great friends, and we really value this relationship. And so, for those who don't know me, John Fitzpatrick. I'm Regional Vice President of Sales for John Hancock. I cover the upstate New York territory, as well as the state of Ohio, which is where I am located in the Columbus area, as well as some additional territory I picked up this year, covering Kentucky and Tennessee. So the real estate has grown to it, but which is great, but we are focused on the people who got us to the dance as well, and that's our friends at CAFL. And with me today, for what I think is just going to be a fantastic presentation, is Mark Berry, Vice President, Life Insurance Sales for John Hancock. And he's going to join us today on a great topic that we are doing quite a bit out in the industry with all our distribution partners. It has had tremendous feedback and positive feedback, and been well received and very applicable in the practices of our producers and of our firm partners as they try to grow their business. So with that, Mark, I'm going to let you take it away and do your thing.
Well, John, thank you. And I really appreciate CAFL for allowing us to come on. It means a lot to us to be invited to these. We take this very seriously. And like I say, we just really appreciate this opportunity to do this. John, just as a sanity check real quick, are you seeing everything okay?
Yes, I'm seeing your screen and it looks great.
All right, good. So I pay attention to what retired people have to say. They get asked a lot of survey questions, and I guess because they're retired, they actually answer those questions. And one of the questions that comes up a lot in these surveys for them, and it's asked in different ways, but the gist of it goes something like this: what was your number one financial surprise about retirement? Now you think about that. What would you think they would say, right? Number one financial surprise. And I every year fully expect it to be healthcare, right? I keep waiting for that to pop up. Or maybe the price of golf, because if you're golfing every day versus once a week or once a month, that's an expensive sport. But time and time again, the answer by far is taxes. And if you think about that, it's kind of fascinating because, like we're all paying taxes right now during our working years, and they did too. And yet something happens when they retire that changes all that. There's some kind of surprise that happens. And that's what we're going to explore here on this little simple drawing. It's a napkin presentation. I developed it really for myself years ago that I would show to my clients. I found many of them are visual learners. And so, if you're meeting with people like me, you can show me a simple picture. It really helps tell a story or kind of an idea or a theme. So if you want to do this with me, I'm going to tear off a blank sheet of paper. So what you should have here is just a white screen right now. And we're going to draw along together on this journey of explaining to someone this whole idea of saving for retirement and what's coming when they get there. And so the way I would always start it, I would put this line at the top. And if they were my client, of course, I knew their income. But I would tell you, even if you don't know their income, ask it. Because if we're really going to talk about retirement for them, this is an important number. How much are you making? But my sample person is a guy named Henry. He's 45, and Henry is an acronym, if you haven't heard this before, that stands for high earner, not rich yet. And the point of Henry is really twofold. One is we're looking for someone that's a high earner, and that's all relative, of course, but someone that has enough disposable income where they could save extra for retirement and kind of want to, right? The other part, though, the not rich yet part of Henry is also important, because this message today probably isn't for a $10 million person. This is for someone that wasn't born into wealth, but makes really good money and knows that it's all on them to save for retirement. They've got to get this right. And these people are starving for ideas, concepts, ways to save for retirement. They'll be very open to a message like this. So that's kind of the setup. That's who we're looking for. And so then you think about, well, then how does Henry save for retirement right now? Well, if he's got a qualified plan, that's the first thing I would draw on here is a qualified bucket, right? A place to save money in any kind of qualified plan. And this is IRAs, 401ks, SEPs and simples, and anything of that pre-tax qualified realm. Now, the most popular by far is a 401k. And if you don't know this number, this is a good one to know if you don't know it, is what's the maximum amount that Henry can put in this year. Each year it changes. I would encourage you in January to look that up and know that number. And the reason it's important is because it's the number that the federal government says he can't put any more. And so this year for Henry is 23,000. Now, if he were 50 or over, he could add another 7,500 to that, but Henry's 45. So 23,000 is the maximum that he can put in here. And so all puns intended, that's a drop in the bucket. Henry could put a lot more than that away. And so he would if he could, but he can't. And so that opens up the opportunity then for us that however much he wants to put in there until he's satisfied, maxes it or gets his company match, whatever it is, there's a point where now he's ready to come out and look for other ideas. But before he can get to us, there's a major intervention that I put right here that I call the IRS. Now, you can call them what you want, but if you've never done this before, this is a fun little trick to do. Write the words the IRS and put it very close together. And some of you, it takes a minute, but you'll see what that spells. And it spells theirs. And it's interesting because this money is theirs. If you really look at the way this works for a W-2 employee, which I am, right? John and I are. So what happens to us and to most Henrys out there is that they don't get this money and pay it to the IRS. Rather, it's withheld. So what happens is the IRS comes swooping in first before Henry even gets to see his money, and they withhold this. And, it's interesting. Comedian Chris Rock, years ago, before he was slapped by Will Smith, he once said this, and I think it's pretty profound. He said, you don't pay taxes, they take taxes. And I think for Chris Rock, that's pretty profound. And that's exactly what happens here. And the reason I kind of hammer this point home is that because it's done that way, a lot of people don't go back and look at what happened. They just know that some taxes have to be taken, and then I get the rest. And we're going to come back to this in a few moments because it's important. But that's kind of where we are. The money is taken. Finally, Henry then gets to this beautiful bucket of investing. And I love this bucket for a couple of reasons. One is there's no government imposed limitation on how much can go in here. Okay. Now, partly because they've already taken theirs, they've taken what they want. Okay. But he can put now as much as he wants in this bucket without a limit. But the other thing I love about this bucket is there's so many other ways to invest money here than a typical 401k, which has some mutual funds. So really great place to put the extra money in. But here's the issue with this bucket. It's this nagging little hole in the side that's leaking tax. And you kind of think about how this works, right? The money's been taxed once already. So it's after-tax money going in here. We invest the money for Henry, do a great job. He sells it for a profit, and then he pays tax again. And this is capital gains tax, income tax, right? And so kind of a tax-as-you-go scheme, if you think about it. And I will say this too, this drawing right here is oversimplified, but this actually represents most people's retirement plan. Many of you on this call might be just the same way, right? You might have a qualified plan, and then you're investing the money somewhere else, and we're all going to hope for the best at retirement. Now, I will say as Henry gets to be wealthy, many times he's introduced to another product out there known as annuities. And I want to give annuities their due because there's some features to annuities that make saving for retirement interesting. One of them is this idea of the after-tax tax deferral, okay? And it's important I said after tax. If you have a qualified annuity, simply put it in that left bucket under the qualified plan, because at retirement, that qualified annuity acts just like an IRA or a 401k anyway, right? So put it over there. But I am talking about those nice after-tax annuities and that nice tax deferral. So now if you got something like this, you're feeling like you've got a really diversified retirement plan going here, right? This is pretty awesome. But here's what matters in this drawing. And it's this dashed blue line at the bottom. This is the day Henry retires. So the way it's structured on this drawing, everything above this dashed blue line is the accumulation phase of his life. He's still working, accumulating wealth, getting ready for the big day when he retires. The day he retires, he transitions and goes below this dashed blue line to the distribution phase. And here's our message to Henry right here. It doesn't matter at retirement what you're worth below, or I'm sorry, above the dash blue line. What matters is what you're worth below the dash blue line. And it surprises people. They're like, well, what's the difference? Well, let's think about this. So if Henry has a $2 million IRA, for example, okay, to his statement and to the IRS, Henry's worth $2 million. But we all know when he tries to take that money out, that's not worth $2 million to him to live on, because there's that unpaid tax that's still due. So I used to actually do a disservice for my clients. I was asked many times to calculate a net worth for them. And I don't know why they wanted it. I think some of them like to compare themselves to their golfing buddies and tell how much they're worth, right? But they would ask for this, and I would dutifully give them this number. But here's the problem with it. Net worth is above this dash blue line. Because again, if they had a $2 million IRA, I said they were worth $2 million. If they had 600,000 of Coca-Cola stock that they bought for 100,000 10 years ago, I gave them credit for being worth 600,000. And yet there's unpaid capital gains tax on that stock. When they sell it, it's not really worth 600,000 to them. It's worth 600,000 to the IRS. And so we've kind of fallen prey to this surprise of using the IRS number in when we're calculating how much money we have. And I think that's a surprise. I think that's one of the surprises about retirement, is that everybody has this number in their head and on their statements. It's not really what they can live on, right? But let's go back to the taxes that Henry's paying now, because it sets up some of the surprises later. What's Henry paying right now? So he's not retired. He's still working. The first one under theirs is federal income tax. I'm sure we all pay that, or at least if you're not, you should be, right? But then depending on what state you live in, you might pay a state income tax. And then there's this interesting little tax, a sneaky one, the Medicare tax. Now, you pay 1.45% Medicare tax on January 1st, right? That's when it starts, 1.45%. Then in Henry's example, if he gets to income levels of 200,000 or 250, if he's married filing jointly, there's this additional 0.9% withheld from his paycheck. And what's nice about this is Henry doesn't have to worry about notifying the government or the IRS and saying, hey, I just want to let you know I'm making 200,000 now, you should withhold this extra. Oh, no. They get it automatically. And so it's a very convenient service that they provide. The S in IRS is service. This is a convenient service because they will come after this money, automatically withhold it on your behalf. So you can rest assured that will be taken care of. The most fascinating part, though, of the current tax code is known as SALT. Some of you have probably heard of this term. It's been around a long time. It stands for state and local tax. And prior to the current tax code, people could write off an almost unlimited amount of state and local tax that they paid if they itemized deductions. So on Schedule A, there's a place on there that says, I paid this much state income tax, I paid this much local tax, property tax, whatever, and that was a write-off from your federal taxes. What's interesting in the current code is that is now limited to $10,000. Now, for the high income tax states, that's a significant blow. Let's take a look at the map of the United States. And you probably haven't seen this map. If you haven't, it's a great map to look up each year. This is income tax by state. And the redder the color, the darker the red, the higher the income tax. So after you look at your state, wherever you live, check out California here, right? That's the highest in the country at 13.3% state income tax. Pretty significant. So let's do this. This isn't exact math, but let's just work with me here. Let's say Henry lives in California and he makes $100,000 a year. He would pay roughly $13,000 in California state income tax, 13,000. But remember, SALT is limited to 10. And so here's a person making 100,000 in California that's already limited on what they could write off when it comes to state income tax. And I would argue that someone in California making 100,000, they might not even qualify as a Henry, right? I wouldn't think they have a lot of disposable income out there. So let me look at a different state. So I live in Florida, and if you'll notice, it's gray, and that's because we don't have a state income tax. And the reason is all of you people coming down to Florida, I would encourage you to come down and visit often. Come to our beaches, come to our amusement parks, come as often as you want, and please, please buy something, spend some money, because the reason Florida has no state income tax is we have the tourists pay for it. So thank you for coming to visit. I'm from Tennessee originally, where I grew up. Same thing, no state income tax. Our saying there is, y'all come back now, you hear? And that's basically saying don't move here, but keep coming visit, right? So, but the one I want to focus on, I think is fun, is Texas. So again, no state income tax in Texas. So if Henry lives in Texas, wow, he's golden, right? There's no problem there. But remember what SALT stands for: state and local tax. Well, what's local tax? Well, that's property tax. So I'm going to switch this map now, and keep your eye on Texas, because as a property tax state, Texas is one of, not the highest, but it is certainly one of the highest property tax states in the country. And I would probably argue that Henry might own a nice car or two in Texas, maybe a house, some property, a ranch, right? And so I guess the point here is that on this SALT deal, it doesn't matter what state Henry lives in. That $10,000 limitation is going to get him. And it did. The first year, it was significant. It surprised a lot of people because they didn't really plan for that. The beauty of what they did, though, and I want to really get to the brilliance of the people that write our tax code and manage it, right? When Congress passed that current act, and by the way, it was called the Tax Cuts and Jobs Act, if you remember. What's interesting about the Tax Cuts and Jobs Act is it was neither. It didn't make a job, and it didn't cut tax. At least for us, it cut some corporate tax, but it really didn't cut tax for us. And here's a perfect example, but here's where it was brilliant. They didn't have to say we raised taxes, because they didn't. What they did was they limited Henry on how he could write taxes off. So they raised revenue. Okay. See how brilliant that is? So yeah, I didn't raise taxes, but they didn't tell you, but they raised revenue, right? It's awesome. I get a chill, John, every time I present this, I get a chill thinking about how brilliant the people are that do our tax code. But let's keep going. Down at the taxable bucket, couple of interesting taxes. Capital gains tax, the top capital gains rate is still at 20%. And then to the surprise of some people, the Affordable Care Act tax is still alive and well. This is a 3.8% tax on unearned income, and that's right here in this bucket. And it's triggered at income levels of 200,000, 250,000 for joint filers. If those numbers sound familiar, it's because they are. That's the same trigger moment for that additional Medicare tax too. So what I would say to people, if you've got clients in your book of business making 200,000 or 250, right, you can let them know that they pretty much have a target on their back where the government has said, you make enough money where it's your civic duty to pay more tax. And so, you know, God bless America. There you are right there with that. Now, so here's the thing about all of this. None of this explains yet the surprises about retirement. This just sets up what's going on now. So then you go, well, why would Henry be surprised about taxation and retirement? Let's go through a few ages where he might consider retiring and talk about some of the ramifications of that. So we're going to start with age 55. So Henry's come to us, he's come to you, he's your client, and he said, hey, I'm burned out, I'm 55, I did well. You said I have a great net worth, right? So I want to retire. I would say to anyone that ever has someone saying about retiring early before 59 and a half, caution, 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 because now we got to not just look at net worth. What we start having to look at is where is the money? Where is it sitting? And I don't know if you noticed this slick little thing I did here, but as soon as somebody says they're going to retire, I added spigots to these buckets. You may not have noticed that. Why? Because the day you retire, these buckets are no longer accumulation vehicles. They are now distribution vehicles. And that's when things change, right? That's when it starts to happen. But at this 55 thing, there's a couple of buckets here. If you start pulling money from before 59 and a half, you could incur a 10% penalty, which is, that just goes to the house, right? It's going to the government. Obviously, the qualified plans is one. The other one is gains on annuities. I think that's little known that if before 59 and a half, any gains pulled out of an annuity are subject to that 10% penalty as well. So then Henry goes, well, I don't want to pay that. Well, the problem is most of his retirement assets probably are sitting in those two buckets. And so now we got a real quandary here. We told him his net worth was great, which it is, but we never really talked about where the money is. And I think that's one of the surprises about retirement is you really have to understand not just how much the pile is, but where it's sitting and how it's going to act when you start taking it out. So 55 could be a surprise. I think there's actually a bigger surprise at this one, my favorite age, at 59 and a half. And I always ask a group of people, why is it a half? You know, what day is that? I mean, just think about for you, think about your birthday, and then you have to go calculate out 6 months. You know, what if you get that wrong? I don't know. Maybe there should be an app or something that tells you what day that is. I don't really know. I think it's kind of funny. You know, I asked this, you know, why did they do that? And the answer is, I have no idea. I just think they like messing with us. And so, but here's the thing about 59 and a half. That's the day that you are old enough and mature enough to get to your own money. Because that's what this is. That qualified plan, and let me just put it back in Henry's boat, right? He earned every dime of that. He had a company willing to match him for his skills and whatever resources he brought to the table. That's his money. And yet, before 59 and a half, he can't get to it without a penalty. So I just think that's fun. But here's even a bigger surprise, right? Let's say you're 59 and a half, you're ready to take that money. Look what happens here. I don't know if you saw this, but you create something when you pull money out of this qualified plan. And by the way, gains on annuities, okay? You create something known as AGI, adjusted gross income or ordinary income. I think this is a surprise for retired people because they think I'm retired, I don't need to worry about income tax anymore. Well, if most of your resources are in that qualified bucket, nothing could be farther from the truth because you never paid income tax on that money. The first penny that comes out of that bucket is fully income taxable. And so that's a surprise to people. It's like, what? I never really thought about that. So yeah, you better care about the tax code when you retire, if that's where most of your retirement money is. But let's keep going because it gets even better. At 62, we become eligible for the first time for that other pile of our money known as Social Security. And if you remember that first paycheck when you worked at Domino's Pizza or wherever it was, you saw this, who is this FICA guy? Remember that? That was FICA was part of that Social Security thing. So you've been saving for this your entire working career. But here's what's interesting about Social Security, and this surprises people, okay? Up to 85% of your Social Security check can be income taxable. And that doesn't seem to make sense. And if it doesn't make sense to you, good, because it doesn't to me either. That's how it is. And so then you go, well, then what triggers taxation on Social Security? Well, a lot of people would say AGI, right? You pull a money for qualified plan. You know, it's even worse than that. I want you to watch carefully what happens here. Okay, I added a letter to it. I added the letter M, and which creates not AGI, but MAGI, Maggie. Around Christmas time, I would say Magi, but this creates Maggie. What is that? Well, that's called modified adjusted gross income. That is adjusted gross income plus some other income. Well, what is that? Well, I think the most fascinating one to me is municipal bond income. So muni bonds are income tax free. That's why people get them, right? They want that income tax free money coming in from a muni bond, and they are income tax free, but you report that income to the IRS. Well, you go, well, who cares? Well, this is when you care because they use that reported modified adjusted gross income to determine when to tax Social Security. And that threshold, by the way, is very low. So you can go ahead and assume for most people, 85% of their income is going to be taxed from Social Security. So another brilliant play. I mean, again, the chill bumps are all over my arm here talking about this, but let's keep going. Age 65, this is when it gets really real, because then you're eligible for Medicare, and everybody loves their Medicare. Medicare comes in several letters. Medicare Part A is free, right? I always do the quotes. It's free because that's the hospitalization part. You don't pay a premium for that. You get that. But Medicare Part B and D both have a premium. D is the prescription drug part. But I want to focus on B. B is the big one here. That's the doctor part. That's where all the other benefits are. We even have Medicare supplements to boost some of that. My childhood idol, Joe Namath, is selling Medicare supplements on television. If you watch the same channel as I do, it's amazing to me that guy is helping sell Medicare supplements, but he is. And so what happens is we're doing that, but there's a premium for Medicare Part B. And if you get AARP magazine or anything else, what you're going to hear is the premium for Medicare Part B when you're 65 is $174.40 a month per person. So a married couple, each person, if they're both 65, would pay the $174.40 per month. But got to go to Medicare.gov to get the whole story. So let's visit Medicare.gov. This is a screenshot of Medicare.gov. And you'll see a very convenient table where they show you your Medicare Part B premiums. All the way to the far right, it says you pay each month in 2024. And you can see it, the very first one, there it is, $174.70. Unless you got some income coming in, right? And you can see this chart, that 174.70 can more than triple. Now, a couple of interesting things about this chart. One is the bottom row was just added a couple of years ago. So could they add more rows? Of course they can. The other thing is these numbers on the far right are set by the Medicare system each year. So they pretty much decide what they need to charge for that. It's not, Congress doesn't set that every year. But I think the most fascinating and fun piece on here, I don't know if you've seen it yet, but I'm going to circle it for you, is right up here at the top. What they use to determine your income is modified adjusted gross income. Now get you some of that, right? That's pretty cool. So again, you got municipal bond income, tax-free. You might have someone that has nothing but tax-free money coming in, be very shocked to find out that income could count against them when it comes to paying their Medicare Part B premiums. And then finally, it's now age 73. It used to be 70 and a half, then it was 72. When we introduced them to a brand new acronym, RMDs, Required Minimum Distributions. None of those words say this to Henry. None of those words say, Henry, we, the government, think you should pull this much money out to live the lifestyle that you want to attain. No, those say, we require you to take out this minimum amount. Okay. Why? Do they want Henry to live on that? No, they want Henry to pay tax. We all know what that is, right? And so what you've got now is truly a brilliant tax code, because they encouraged us to save in these 401ks and all that. And then they're sitting here waiting for you to pull it out at the end. It's beautiful. And I can tell you, clients that I've sat down and done this drawing with, and I didn't spend as much time as I have with you. You can do this in 5 or 10 minutes. It's quick, but they get upset. I mean, you see some emotion there. They'll cross their arms, or I've never had anybody start crying, but you know, they do get a little emotional. And they ask me eventually, it's like, what's the point of all this, right? Why did you show me all of this? You're kind of, you know, raining on my parade here for retirement. Well, if you notice at the far right of the drawing, I left an arrow open, and that's because I want to introduce Henry to a fourth bucket. A fourth bucket he can create. It's so cool that I call this bucket the tax advantage bucket. And let's understand what this is. This is after tax money, okay? It's not qualified, but what's cool here is that, first of all, Henry can put as much as he wants into this bucket. The next thing that's cool is this money's going to grow tax deferred. So that's two good things already. But even better than that, when he takes it out, if he follows the rules and does it correctly, it's going to cross this dashed blue line, income tax free. And as Martha Stewart used to say from prison, that's a beautiful thing. Because if you've got income tax free money coming out, man, think about now how you can start to manage retirement. But here's something I want to give you that's even more powerful than that. If you want your power words today, if you want your golden nugget for this entire presentation, this is the part I want you to hear, okay? So wake up if you've been snoozing and listen to me here. This is important. Not only does this money come out income tax free, but it comes out as non-reportable income. And this is powerful. Why does that matter? Well, let's start scratching off some taxes. So let's go to the federal tax under theirs. There's no federal tax on non-reportable income, right? We haven't reported it to the federal government. They don't even know about it, so they can't tax it, at least not now. There's no state income tax on it either. There's no effect on Medicare or SALT, anything, of course. There's no capital gains on non-reportable income. Even the Affordable Care Act can't get at it. And because it's non-reportable, you want to pull it out at 55 or anytime before 59 and a half, there's no penalty, right? You're fine. At 59 and a half, of course, there's no tax on it. We already talked about that. But even better than that, there's no effect on your Social Security taxation. There's no effect on your Medicare Part B premiums, and there's no RMDs. What we're talking to Henry about here is something that at retirement neutralizes the tax code as we know it. Now, do you think he'd like to hear what we have to say next? Because a lot of us are itching to say what the solution is, right? But here's your chance. Here's when you pounce, because you got to get him nodding his head. You go, if I could show you something like that, Henry, would you be interested, right? We get their buy-in, and this is when we tell them what this is. This is life insurance. This is LIRP. This is doing that overfunded, do the minimum non-MEC-SOB. You can explain all of that to Henry, right? How we're minimizing the death benefit, maximizing the cash saving for this event here. It's perfect. It's a perfect little solution for this, right? And so it's really wonderful in several ways. But I think what I like is we can talk some big words. People like fancy words sometimes, and I think hedging is one of those. You can talk about hedge fund managers and hedging your bets. But when you talk about hedging to people, they think you know what you're talking about with investing. I will say this, hedging for me is going out in the yard and cutting those green bushes between my yard and my neighbor's yard. And I'm not very good at hedging, I turned out. But let's talk about financial hedging. What do we got here? I'm going to start the first. I'm going to put these at the top right. The first one is a way cool tax hedge. And I think this is obvious, but let's kind of go through this, right, to manage it better. Without this bucket, the money you're pulling out, you're at the full mercy of the tax code. But let's say, for example, it's November and you're pulling money out of the qualified bucket. And if you pull one more penny out, you're going to go to the next tax bracket, or you're going to go to the next Medicare Part B premium level, and you'd rather not. Well, without this bucket, you have no choice. You got to live. But now, if you have something over here with the life insurance, you can simply turn off that qualified bucket for a month. Let's use the life insurance to fund our lifestyle for a month. And then January 1st, you can use your qualified bucket again. Because see, the tax code resets every year. And that's something we can take advantage of. They're giving us that opportunity. So let's take advantage of what the IRS has given us and reset it every year and start over. You can imagine the kind of things you can do with that. The taxable bucket, maybe there's a year where selling a certain stock isn't really a good tax move, but you need the money. Again, if we got something like this, maybe you can put that sell off for a little while. So tax hedge is a really cool story. The other one I would mention is a longevity hedge. One of the most popular ways to distribute long-term care and chronic illness benefits now is through riders on life insurance. LIRP should be no different. At John Hancock, we've got a chronic illness rider that you can add to a LIRP that, first of all, there's no underwriting for it, and there's no charge either up front on it. You only charge someone if they use it. And so you can add this to a LIRP structure, and it doesn't affect the ability for the policy to build up cash. And by the way, it pays out as an indemnity rider. And so for someone that wants this retirement idea and then they need that, they would probably want it to pay out as indemnity anyway, because they still want to get the check, right, and pay for all the stuff and don't have to do anything with any of those keeping up with cost things. So it's a really cool play there. as far as a longevity hedge. The last one I'll mention is a time hedge, and I'll give you an example. It's a real one. It's a personal one for me. My father was killed in a car wreck when I was 7 years old, and my brother was 5, and he was 29. He didn't really have time to grow any of these buckets. As a matter of fact, we didn't have anything, including life insurance. And so my dad didn't have time to do any of this stuff, right? Well, what if Henry doesn't have time? At least we've got, what you all have used these words before, right? This is the self-completing retirement plan. Whether he's there or not, there's a death benefit that is significantly more than any premium he's paid in, that at least can go to the beneficiaries, and that part of his retirement plan can be complete. So there's nothing else in his portfolio that could give a time hedge like that. And so I'll wrap it up with this. We have it here at John Hancock. We've created a client guide. I've given you the QR code there if you like the QR code stuff, but it's in digital format. It can be forwarded to a client. It can also be printed. It's printable. It's a very serious guide, but in this guide, it talks about a lot of these numbers that I've shared with you on this drawing. It doesn't do the drawing, but it talks about specifics of this. It's a great leave behind. If you ever take the chance and do a presentation like this and try to draw it out, this is a great leave behind for them to take with them. Answers a lot of those questions about taxation at the different ages. And so with that, I guess I'll end it here, and I'll turn it back over to whomever to see if there's any questions or outbursts or general comments.
Yeah, Mark, thank you so much. That was great, really excellent. I've seen you do this a lot, many times, and you do it better every time. It's an awesome presentation. I had 2 points I wanted to dovetail on before we open it up for questions. The first one is, we're talking about how this affects the client, right? Henry's our client, and that's how this all impacts him. But there's another, I think, party involved here that we all need to convince on this sometimes. I am sure that all of you, when you work your business and you're working with your producers and advisors, we have a lot of them out there that don't necessarily believe life insurance in retirement or permanent insurance in retirement is that important or really a big thing. They might be investment people. They do a great job of accumulating that accumulation phase above the line, and they help the client accumulate. But then when it gets to retirement, I've worked with many investment advisors who don't see the value of the life. Usually it's like, okay, well, the kids are out, they paid off the house, and we'll keep a little bit around for burial, but we don't need a policy. And so it's not just the client we're talking to here. This is an advisor conversation. So to me, it's also showing them, because it's amazing to me how many advisors that, who are professionals and know this business don't really understand the depth of what Mark went through and the impact to the client, and how life insurance is such a great solution for it. So I would just urge that to bring this to those conversations, because it's not just the client, it's also the advisor we're talking to. The second part I want to leave with on it, and then we'll have the questions, is I would ask everybody to, after I heard Mark do this presentation, and I started doing it myself, and I'll never do it as well as he does, but as I did it, I enjoyed doing it, and it's really fun to do. But one of the things I took out of it, and if you have a pencil or a pen and paper, I'd ask you to jot this down really quick and remember it. Everything that Mark talked about represents what I call the DNA in life insurance. It's in the DNA of that solution, and the DNA stands for discretionary, non-reportable, and accessible, right? Because it's discretionary because we can put as much as we want into it, and we can take it whenever we want, and we can take as much as we want. Okay, non-reportable, I don't have to go through that. Mark went through how important that is and how beneficial that is and how unique that is to this solution, as opposed to other investments. And then accessible, right? We know we can get to it. Mark talked about the qualified plan money. I can't take it without penalty. They're preventing you from taking your own money in these tax codes. Well, I don't have that problem with the life insurance solution. It's always accessible to me, how much I want, whenever I want, at the time I want. So I love that, putting that DNA behind that, to take this with you, and hopefully that'll, help kind of ring the bell and help us all remember that. So Kelly, with that, we can open up for questions and comments from the group.
Yeah, does anyone have any questions they'd like to have answered while we have John and Mark here?
While they're thinking, Kelly, because I know there's always a pause, no one likes to be first, right? But I do want to point out something that's interesting about this story this year specifically. Any sports fans on the call have heard the name Jim Harbaugh, right? Jim Harbaugh was the head coach at Michigan, and Michigan actually recruited him from the NFL to come coach at Michigan. And one of the things they did to keep him there was they set up a series of life insurance policies where they were funding them and basically doing this idea. And he knew if he stayed long enough, those policies that he would own them, and the cash would be his, that he could choose the beneficiaries. And what's fascinating about that is that it worked for Michigan. Jim Harbaugh stayed long enough to get them that national championship. He just won it this year. And if you notice what happened, he won it. The NFL's calling, and now he's going to an NFL team, the Chargers. The rumor has it that he's actually asked the Chargers as part of his structure if they will do the same thing, that he liked it that much. And so you kind of look at that. It's a huge case, but it's the same idea. It's using life insurance in a unique way that a lot of people haven't thought about. I just think this is the year of the Jim Harbaugh story because he's in the news and everybody knows who he is. It's a great story to talk about this year.
And even though I'm from Ohio, Mark, it's okay you told that story. I won't take offense.
Howard wanted to know what type of life insurance works the best in this scenario.
Anything that says John Hancock, right? John? Yeah. No, John, I'll let you cover that one. Go ahead.
I agree. I agree. Well, in a broad definition, and Mark, jump in whenever you want. Broadly speaking, any permanent plan can work, permanent life insurance, but getting underneath that, what operates best, and I think Mark was actually pointing that out earlier, is usually it's going to be an accumulation type of product that's designed for accumulation. And, like John Hancock specifically, we have a very broad and deep portfolio of products, and we actually have 2 accumulation products, and depending on the client, but where I like to talk about it is we have a very competitively priced but more so importantly, really strong at income streams is our accumulation VUL product. And we've actually made some, and not only does it accumulate well, but it distributes even better in those income years when you want to take it, however you want to take it. We recently did some work on our sub accounts and our expenses, and our weighted average. When you illustrate, a lot of people show the weighted average of all your funds available. And by the way, we have 55 funds available in ours. We have a broad portfolio. So the expenses on our weighted average are now way down. Well, less expenses in that portfolio means more performance in the product. And so our weighted average fund selection in our accumulation VUL makes that really, really work well. You can use other products too that accumulate well and distribute well, but that would be, my recommendation if you have a client that is good with the variable, wants to be in the market. We also have an accumulation index product that's extremely competitive and accumulates, and that's where you have the downside protection with the upside potential of the index buckets. Okay, but this is to supplement that retirement and backstop, but we also call that backstop because this is your backstop if you run out of money or if you don't want to take in those years in the examples that Mark used. This is a great place to do it, and that's going to give you the accumulation you need to have meaningful retirement income in your life insurance.
That's really diversifying a portfolio by adding that life insurance into it too, just for those reasons.
Absolutely.
Yeah. Is there any other questions? I want to thank you all for coming. John and Mark, this was fantastic. We're so excited for the series, and this was wonderful. There was so much information, so we really appreciate it.
Thank you, Kelly. Thanks
Thank
to
you
everybody.
again. Really appreciate this.
We'll see you next time. And again, thank you for your partnership, and we'll be talking.
Sounds
Thank-
great.
thank you.
Thank you.
All right. Take care, everybody.
Bye.
Bye-bye.